Good afternoon, everybody, and thank you for joining us for today's lunchtime webinar presentation, Slay the Student Loan Dragon, with our special guest, Justin Rice, who is a financial advisor with Personal Wealth Strategies. This has been a very popular topic. I get a lot of questions about student loans and what to do with and about student loans from my clients. So I asked Justin to put together this presentation for everyone, and I hope that you do enjoy it and get value out of it today. A little bit about Justin. Justin is a graduate of the Catholic University of America in Washington, D.C., and he graduated with a bachelor's in biomedical engineering. So a little bit of a shift for Justin. Continuing his education, he attended Rutgers University, where he obtained his master's degree, and he began his studies in finance at that time. He earned his certificate in financial planning from Kaplan University, and in March of 2015, he passed the incredibly demanding CFP certification examination and went on to gain valuable industry experience, and thereafter earned his full CFP designation in September of 2018. Furthering his education in 2019, he obtained the Certified Student Loan Professional designation, which will allow him to help clients formulate the most efficient strategies to eliminate their student loans. He has been a sought-after industry speaker, presenting to several groups, including as an expert appearing before the Financial Planning Association New Jersey chapter. In 2021, Justin earned the certificate in blockchain and digital assets from the RIA Digital Asset Council and New York Institute of Finance. Justin joins an exclusive group of financial advisors with the credentials to properly educate clients curious about this new and evolving technology. So you can see Justin is very much focused on a lot of the newer areas of financial planning and financial planning areas that are attractive to a lot of my younger clients. So I hope you find that very valuable and interesting today. On a personal note, Justin was born in Baltimore, Maryland. He currently resides in Cliffside Park in New Jersey with his wife, Susie, and they are expecting twins in January of 2022. So Justin, please go ahead. The floor is yours. Take it away. And before I switch it over, I will just say, if anyone has any questions, please go ahead and type them into the question box on the platform, and Justin will have plenty of time for questions and answers at the end of the presentation. Thank you, and Justin, go ahead, it's all yours.
Thank you so much, Gina. I really appreciate the opportunity to come and speak today about student loans. This is a topic that I've been really passionate about over the last several years, and I thought I knew about student loans until I got the designation of the CSLP. Then I realized I really knew nothing about student loans. So they're such a unique type of debt, and anytime the government gets involved in anything, they make it more complicated than it has to be, and so that's why these are particularly complicated as well. Just looking and going over the kind of the agenda for today, I want to first kind of review a student loan overview and why it's not like every other debt and kind of the different types associated with student loans. Take a look a little bit at the income-driven repayment plans and kind of how they're calculated and why they're different than a normal type of debt. I'll go into kind of the truth about public service loan forgiveness, and then take a look at student loans under the CARES Act and all of the new kind of legislation that's been coming out, really focusing in on the most recent development, which is the public service loan forgiveness limited waiver, which just came out in early October. And so there's been a lot of confusion about that, and we're still getting resources from the Department of Education to try to understand exactly what's going on with that, and I'll get into it a little bit of that today. And then finally, for those that have private debt, or where these public benefits are not beneficial to you, and it's really going to be focusing in about the interest rate. We'll look at refinance options and what you can do there. For a broad spectrum, looking at the different types of student loans, there's several, and really this is focused in on federal loans because that's where you have a lot of the unique planning strategies. Once you get into the private loans, it really becomes like any other type of debt, where you're really just focused in on the term that you get and then the interest rate. Whereas with the federal loans, there's a bunch of different types, and it has caused a lot of confusion. Ever since 2010, the main loan program has been the direct loan program, but there are many people that still have the older types or different types of loans, including those FFEL loans, the Federal Family Education loans, which were actually backed by the Department of Education, but they were issued by private banks as well. So they weren't actually owned by the Department of Education like the direct loan program is. Now, within the direct loan program, there's two main offshoots of that, the subsidized loans and then the unsubsidized loans. So in a subsidized loans, they're a little bit more favorable in terms of the benefits to the borrower, where if you're enrolled at least half time or you're in a period of grace or deferment, the interest is actually paid for by the Department of Education. So you're not responsible for that interest that's built up while you're not paying on the loans while you're either in school or deferred for some other type of reason. For the unsubsidized loans, those are accruing interest, although you don't have to make a payment on them while you are going to school or in a period of deferment. The interest on those loans is actually being accumulated, and then it will capitalize into the principal balance once you enter into a repayment plan. Now, when looking at ways to pay back the federal loans, there's two basic ways. There's the balance-based repayment, and that's where the payments are based on the loan balance and the interest. And so that's pretty much like every other payment. You can think of a mortgage that's balance-based. You have the 30-year term, you have the interest rate, and then you have the monthly payment that's going to be level for the 30 years. So that's really similar to the level types of repayments. Now, student loans are a little bit unique, and they also have a graduated repayment plan where the payments will start low and then increase over time. Now, that's normally, those graduated payments are normally the least favorable to borrowers over the long term, and you're going to pay the most interest using a graduated repayment plan. But where student loans are really unique is the different income-driven repayment plans, and there's several different income-driven repayment plans that have been layered on by different legislation and executive action, and that's kind of where the confusion comes from. But if you are going for that public service loan forgiveness, an income-driven repayment plan is going to be necessary for that. Technically, the 10-year level payment also is a qualifying repayment plan, but the PSLF program is 10 years. So if you have the loan paid off after 10 years and it's forgiven after 10 years, you're not going to have any forgiven anyway. So really, the income-driven repayment plans are a must when you're looking and pursuing for public service loan forgiveness, and you still want to have a favorable repayment schedule. So kind of looking and going back to the different legislative and executive timeline when it comes to student loans, because I think it kind of brings it up to today, where actually we're seeing the rate of new legislation and executive action increase on student loans. So that the Higher Education Act is really the statute that controls the federal student aid and student loan repayment programs. And the first income-driven repayment plan was created in 1993, and that was the Omnibus Reconciliation Act. And so that created ICR, or income contingent repayment. Now, income contingent repayment wasn't very popular due to the fact that very few people were actually eligible for the program, and the monthly repayment calculation was very high, especially when compared to other income-driven repayment programs. So that kind of came along the College Cost Reduction and Access Act, which created IBR, so that made it eligible in 2009. It also provided for long-term forgiveness, which is set at 25 years. So after you're paying on those IBRs, regardless of any profession that you're in, after you paid for 25 years, those loans will get forgiven under the income-based repayment IBR. This act also created the public service loan forgiveness program as well. So then in 2010, Congress passed the Healthcare and Education Reconciliation Act, which officially eliminated that old FFEL program that we had talked about, and going forward, only new loans would be those direct loans. Now, it also included a change to the income-based repayment program, which reduced the amount of the payment that you had to pay, and also reduced the forgiveness timeline from 25 years to 20 years. But it was only made available to new borrowers as of 2014. So if you had any debt prior to 2014, you weren't eligible for that repayment program. So President Obama actually saw this and issued an executive order in 2011 that invented pay as you earn to kind of fast track the availability. So when you look at the new IBR and the pay as you earn, they're pretty much identical programs, just have different loans that are eligible for that. Then Obama made a second executive order, which further expanded the program with revised pay as you earn, which changed some of the repayment plans there. Then you have Trump last year, who made an executive order which suspended interest on the federally held student debt, which was expanded by the CARES Act, which clarified that the interest initially would be set at 0 for up to 6 months and no payments. We now know that that has been extended several times, all the way until January of 2022. We are in the 0 interest and no payment. Now, payments will be scheduled to restart in February of next year. And then in addition to that, there's been some changes with the American Rescue Plan, which actually made the student loan forgiveness on non-PSLF tax-free through 2025. And then most recently, you have the PSLF waiver, which we'll get into a little bit more later. But taking a look at public service loan forgiveness, because that's the main program that if you work for any type of nonprofit or governmental agency, that's what you're going to go for. If you have a very, very high balance relative to your income, you can go for those longer term forgiveness of the income-driven repayment programs. But for today, we'll focus in on the public service loan forgiveness program because that's really is going to be the most popular. Now, one of the biggest things is that it's only available for direct loans and not those older FFEL loans. Now, you can do a direct consolidation to turn those FFEL loans into direct loans and have them qualify for public service loan forgiveness. Now, to qualify for it, you have to make 120 on-time monthly payments while on an income-driven repayment plan while you're working for a qualifying in a nonprofit governmental agency 501c3. Now, this has always been a tax-free forgiveness, so you don't owe taxes on the amount that's forgiven. And currently, it has a very, very high failure rate due to misinformation about the program. The good news is when we talk about the PSLF waiver, they've kind of eliminated temporarily all of those hang-up spots for the PSLF to kind of count old payments that may not have qualified strictly under the program as it was written. And then the legislation is unknown for the future of PSLF. But with that being said, right now, at least we're seeing it being only more favorable to borrowers. They're continuing to add benefits and not take it away. Obviously, that could change. But if you have current debt, meaning you're either in school or have already graduated, the public service loan forgiveness program is actually within the promissory note, so they can't take it away for current borrowers. It would only be for new borrowers if they were to take it away going forward. Now, looking quickly at the executive order and the CARES Act that we've been in over the past several months since March of 2020. That's when the CARES Act was signed into law, which clarified the president's emergency declaration that basically said for federally held loans, meaning all direct loans, not the FFEL and private loans, we would go to 0 interest and no payments through September 30th of 2020. And as I've already said, this has been expanded and extended through January 2022. And I don't think it's going to get extended any further after that. But some people would probably want it to be. And then what's really important for public service loan forgiveness is that these months of the 0 payment count towards forgiveness. That was a big deal when it was initially looking at whether this time would still count towards public service loan forgiveness, and they specifically did state that even though you weren't making a payment on the loans during this time. Now, what the PSLF limited waiver did, which is very interesting, so it just came out, it's very, very new on October 6th. The U.S. Department of Education announced the change to the PSLF program. And the authority of this actually comes from a piece of legislation called the HEROES Act back in 2003, which allows the Department of Education to make changes to the student loan program in response to a national emergency or a disaster. and they're kind of using COVID-19 as this national emergency to give them authority to make changes to the program. So it actually will allow borrowers to receive credit for past periods of repayment that otherwise would not qualify for public service loan forgiveness. So if we kind of go through the checklist of public service loan forgiveness, where you had to have the right type of loans, the direct loans, you had to be on the right type of repayment plan, those income-driven repayment plans, you had to be working for a qualifying employer, and you had to make those on-time payments. They're basically wiping out all of the requirements except for just working for a qualifying employer. So it doesn't matter if you had the old FFEL loans, it doesn't matter if you made payments under a graduated repayment plan or just made the absolute minimum payment that you were required. As long as you made any type of payment on any type of loan and you were working for a qualifying employer, they're going back and counting those months. Now, it doesn't happen automatically. You do have to take action. So if you have any type of non-direct federal loan, which includes the FFEL, Perkins, you will need to actually consolidate those into a direct consolidation loan by October 31st of next year of 2022 in order to have those loans count. If you wait until after that program, the waiver has ended and you won't be able to get those past payments picked up. So that's really the takeaway. If you're pursuing public service loan forgiveness, or you want to, and you're working for an eligible employer, you want to make sure that you're getting all of your payments count. Then after you consolidate into a direct loan, or making sure all your loans are direct, then you're going to want to submit a public service loan forgiveness certification form, and that will officially tell the Department of Education that you are pursuing this public service loan forgiveness, and that you want them to do an account of how many monthly payments that you have. Now, what if you're not eligible for PSLF, or you don't even have federal loans at all, it's just private loans? So if you still have the federal loans, depending on your debt to income ratio, it still may be capable for you to qualify for the long-term forgiveness that I was talking about within the income-driven repayment plans. So depending on the loan program, that would be either after 20 or 25 years. Right now, forgiveness on that type of program is taxable, but like I said, in the American Rescues Plan, they've made it tax-free through 2025, and that may set a precedent to have them continue to extend that tax-free forgiveness of all loans. But really, that's long-term forgiveness where your debt is more than 2 times your income, that you would definitely be eligible for that. If it's more than that, then you can go for it. If it's less than that, then you probably will have to just end up paying off the loans. There are also other types of forgiveness or student loan assistance programs that are tied to work but aren't the public service loan forgiveness program. So I just put an example up here of the primary care physician dentist loan redemption program, where you can actually get up to $120,000 over a 2 to 4 year period for working in an underserved area in New Jersey. And so that's New Jersey specific there, that program, but there's other student loan programs that you can research depending on serving underserved communities or working in some type of rural areas, where you'll be able to take advantage of other types of forgiveness or assistance programs that isn't the main public service loan forgiveness program. Also, what you can do, especially if you're early on in your student loan journey, is take advantage of the income-driven repayment interest subsidies. So this is not a very, very well-known piece of the student loan legislation, in that the interest within your student loans works different than a normal type of debt. In a normal type of debt, if you're not paying enough to cover the interest, it immediately gets compounded into your principal loan balance, and then your principal loan balance will continue to increase. With student loans, it's actually a little bit different in that it doesn't immediately get capitalized into the principal loan balance. It actually builds up in a separate interest bucket that doesn't get charged interest itself. And so you technically have another 0% interest loan that's kind of building up on the side with all of that unpaid interest. And the way that interest accrues depends on the program, the repayment program that you select. So for example, Revised Pay As You Earn has the most interest subsidies, where on subsidized loans for the first 3 years, you're 100% forgiven on any unpaid interest. And then going forward after the 3 years, and also for the 3 years for unsubsidized loans, so for any direct loan, 50% of the unpaid interest is actually forgiven. So even though the interest rate is, says 6%, really it's not accruing at that rate because it's not immediately compounding, and they're doing a partial forgiveness of that unpaid interest. So kind of taking advantage of that. And then once your income increases to a point where you can't take advantage of the subsidies, then you can look towards a refinance. And then that's where, for people with either privately held loans or federal loans where your income is high relative to the amount of debt that you have, and you're fairly confident you're not going to qualify for any of the federal benefits, that's when you're going to look to refinance loans and get a low interest rate or a long term with a lower payment, so that you can help to do that. And I just kind of flashed up here on the screen some of the interest rates that we've been seeing on these loans, and what you'll notice is that they are very, very low. I just did a 30-year mortgage at 3.125%, and that's collateralized against my condo, where these are completely uncollateralized debts, and just around 3 or below 3 for the shorter fixed terms. That is very, very low, and we're a very attractive environment for student loan refinance if that is the right thing and you're not going to qualify for any of these other programs. So some of the further resources before we jump into questions, you've got studentaid.gov, which is the Department of Education hub for all things student loans. And then obviously you've got us here at Personal Wealth Strategies, and our phone number there that you can call. And then another independent website, studentloanplanner.com, is a fantastic resource. And that is also where I send people generally to do the refinance, because when you go through that site, they give you large cash bonuses for doing a refinance that you really can't find in other refinance sites. So at that time, I will take some questions.
All right, thank you so much, Justin, for that overview. And I just will emphasize, I know we have a couple people with us today and a couple people who will be taking a look at this later on, who specifically were interested in some questions about their private loans. So I'm particularly going to draw attention to your email and number there, and let them know they are welcome to contact you for more information and discussion on particularly the private loan side. Again, if anybody who's listening has any questions, please go ahead and type them in the question box or the chat box, and I will share them with Justin. All right, we do have a first question, and this is a good one. Have you ever actually seen anyone get forgiveness?
Yes, that is a good question. And before the PSLF limited waiver, the answer would have been no. But actually recently, as of 2 weeks ago, with some of the extra payments, I helped them get counted towards their loans. I actually officially did get a letter from them, from FedLoan, to the borrower, that they had forgiven all of their loans in the amount of $75,000, which she was very, very, very grateful for. So I actually have seen it in person with a client now, and I envision that I'll see many, many more. For some even that we just left as the old FFEL loans, because they were at a very, very low interest, and they weren't going to qualify for any forgiveness. If we consolidated them. Now I'm advising them to consolidate, because we can go back now and count all of those payments on those FFEL loans and get those immediately forgiven. And so this is unleashed a very wide amount of planning opportunities in the student loan space that people need to be aware of.
Awesome. Okay, another question. Is a consolidation and a refinance the same thing?
So when it comes to student loans, no. With pretty much any other debt, those are interchangeable, meaning people say I'm going to do a refinance, or I'm going to consolidate my debts into one debt and do a refinance. But when it comes to student loans, they actually have two different distinct meanings. So when we say consolidation, a consolidation is keeping the loans for federal student loans, but each time you go to school, you have a different loan for each semester most of the time, and then you might even have 2 different loans for each semester because one's subsidized, one's unsubsidized. So you can get a very, very long list of loans. So when we say consolidation, that is just taking those loans that you have federally and consolidating them into 1 or 2 loans, and kind of reducing the amount of loans that you have but keeping them federal. When we talk about a refinance, that's actually going into the private sector now, where you're going to take your loan and do a refinance into a new loan with a private company, and either taking them away from federal or going from private to private.
Okay, and we have one more. If I want to get a mortgage to buy a home, how do my student loans factor in?
Yeah, so this has actually been a pretty large topic of contention as well. And I think I've got a slide somewhere in here that talks about this. But really, when it comes to student loans, especially right now, when you're looking at trying to buy a home, and there's no repayment required on the loan, so they just see your big balance and they see your 0 payment, and they're like, very confused by it. So the student loan will affect your debt to income ratios when you're looking at buying a home. But if you're going for an FHA loan, they're going to look at all student loans regardless of the payment status. And they're either going to look at the actual documented repayment, which right now would be 0, so they're not going to look at that. So instead, they're actually going to look at 1% of the outstanding loan balance and pretend that that is your payment on the loans when they're looking at how much of a mortgage that you can afford. Now, for conventional loans, the payment amount on the credit report is used, and so that was before the administrative forbearance. But with the administrative forbearance, even on the conventional loans, they're looking at to see what your income-driven repayment plan would be. So we've had to submit, letters to the insurance company saying, that these payments are going to come back on. Letters to the mortgage company saying that these payments are going to come back on at X amount, and this is the payment that you should qualify for. So it's a little bit of a hairy topic, but you can still qualify for a mortgage and have a student loan debt, even if it's a very, very large amount.
Well, thank you so much, Justin, for your time today. And as a reminder to everyone who's here, the recording of this presentation will be available on our YouTube channel in about 24 hours. So if you have a friend or a partner or a spouse that you'd like to share it with, you're more than welcome to do so. And if you'd like to reach out to the firm or to Justin to talk about anything offline, you're also welcome to do that as well. Thank you, Justin, so much. Oh, we have one more question. Hold on just a moment. Yes, one person said she has a question offline. Yes, you're more than welcome to do that. Justin, if you want to flip back to your contact information so that attendee can write that down. And then we actually have another question that just came through, so I was a little premature. That question is it better to look for a fixed rate private loan during present times due to uncertainty?
Yeah, yes. So really, when it comes to the private loans, you have 2 options, either a fixed rate or a variable rate. A lot of the times for the variable rate, they'll try to tempt you with a lower than a fixed rate, but then that, assuming interest rates rise as we expect them to, that will adjust upward. And right now, you saw the rates on the for the fixed were super, super low. Just locking in a fixed rate, making a payment that's affordable. I'm even okay with extending out longer just to make the minimum payment kind of the lowest possible, and then paying extra when you have the cash flow, rather than locking yourself into a higher monthly payment where you can kind of get into trouble down the road. But yes, fixed rate is our recommendation. We don't like variable rates, especially now in today's interest rate environment. And when we see people on variable rates, even if it is low, it probably makes sense to refinance that into a fixed rate at this time.
Okay, thank you so much, Justin. And now I think that is all of our questions that we have. So thank you again, everybody, for being with us. And thank you again very much, Justin, for all of your wisdom and information you provided to us today. And anybody who, again, wants to reach out to Justin offline, please don't hesitate to do so. You can reach out to me and I'll get you in touch, or you can reach out to Justin directly. Thank you so much, everybody, and have a wonderful day.